Hey everyone, this is Hunter Satterfield, one of the partners here at CWA, as well as one of the members of our investment committee. I am joined, as always, by my fellow partner, Brian Bortz, and the managing director of Tectonic Advisors, Brad Sanders. Thank you, gentlemen, as usual, for joining me. This is your August monthly update. For the month of August, the S&P 500 was up right at 3%. Global stocks are up 2.5%. Domestic bonds were slightly down at 0.2%, and global bonds were slightly down at 0.4%. So I'm going to mix things up a little bit. Brian, I'd like to start maybe with you a little bit. And I see you're in your Texas A&M shirt. I've got my UT football back here. It must be college football week. So I want to come over to you very briefly, Brian. And obviously, it feels like every time we record one of these things, we're seeing stock numbers that have gone up so far this year, and really, since the recovery from COVID. So, I mean, in light of that and the continued money that we're seeing injected into the system from the federal government, low interest rates, things like that, we've talked about those things on previous recordings. From your perspective, as somebody working directly with clients, I mean, is it going to continue like this? What are some potential concerns? Sort of what are you speaking to clients about right now?
Yeah, thanks, Hunter. We've talked in previous broadcasts that we expect a bumpy ride up, and I think that's what we're going to continue to see. When you look back over the history of the markets, usually August is not a very strong performing month traditionally. That's not the case this year at all. And I think that you are seeing the power of the liquidity that's been injected into the economy, coupled with still historically low interest rates, which makes everyone feel like they have a little bit more cash flow than normal, built upon that suppressed demand that was there over the last year and a half, where everybody wants to get out and go do something different and enjoy themselves. And this environment, it's difficult to allow yourself to do that. But what we're seeing is this boom of economic growth because of the steps that the Fed has taken. I think that will continue to be the case going forward. We're actually fairly optimistic from an economic standpoint. The growth of the economy, those are all positive things. I think you have to balance that with potential negatives. And some of those potential negatives could be related to the fact that as you look at one of the major market indexes like the S&P, you're going to have a very, very top heavy index. We just looked at the numbers earlier this week, and 17% of the S&P 500 is in three stocks and three names: Apple, Microsoft, and Amazon. And those three companies are very, very large. And right now, the stocks are doing well. I think the concern is going to be what happens in the future in that bumpy ride up. If one of those three companies ever miss earnings or have a bump, that could negatively impact the index. And that will not be a negative impact on the economy. The economy is still strong. So investors are going to start to see a difference between the stock market and the economy. And we have a very strong economy, which bodes well for the stock market.
Yeah, that's great information. Thank you. And I think Brad is, I kind of wanted to hear Brian's perspective on some of the things that he's talking to clients with, and then come over to you on the technical side of things very quickly, because we are seeing a market that has continued to sort of persist in this growth on the way up. And I think, sort of for our viewers and listeners, what types of things are you seeing on the technical side, sort of underneath that, and sort of saying, okay, but on a technical side, we're seeing some differences in these various areas.
Yeah, I think Brian's correct in everything he said. I think from just a technical standpoint, what we see is a market that's very overextended in the short term. Okay, so what I mean by that is we haven't had a market that's been backing and filling the whole year. It's been kind of a melt up kind of situation. And that feels great. And it certainly looks great on paper when you look at your statement, but it doesn't always contribute to the healthiest of a market, because the healthiest markets are the ones that you have your 2 to 5% pullbacks every couple months. It allows things to breathe. It allows stocks that are getting overpriced to maybe reprice and make people rethink what they're doing. If it goes up every day, people stop examining it with a critical eye, and the stock can kind of get severely dislocated from its actual fundamentals. And so now we see that more broadly in the market, where there's a little bit of a gambler's mentality with portions of the market. And those portions of the market continue to go up, so it's not getting any better. So in the short term, we would expect some volatility. Brian said a bumpy way up. We think part of those bumps are going to be, if the market's, this complacent, then we're going to get a period of volatility. Maybe you have a week the market drops 6 or 7% out of nowhere. That's not something to really trouble you as an investor so much as to just say that wouldn't be terribly unexpected with the kind of market we've had so far this year. And it wouldn't necessarily be something really bad for the intermediate term. That would be something that would be healthier as the market starts to go in and we start thinking about 2022. If we could have like a little, 5% pullback or something, that would make me feel better as an investment analyst about forecasting a pretty nice 2022 than it would right now with the 2 years we've had back to back. Secondly, I got a really good question from a friend the other day that's always peppering me with market questions. And he was just like, hey, I know you're kind of more of a value guy. Do you think this value thing is over? Because we had a nice 8-month run of value. And then now in June, July, and August, growth's outperformed value by quite a bit. And my answer was, kind of a very, very snap no, it's not over at all. We're closer to the beginning. But he kind of made me think about it. So I went back and retraced my steps and kind of looked through some of my research. And in our newsletter, our report that's attached to where you can get this video on the Kane Waters newsletter this month, I actually put that chart in there from AQR. And it shows value compared to growth in terms of cheapness. Value is in the 90th percentile, no matter what sector you want to look at. It's almost the cheapest it's ever been. The last time it was this cheap was in 1999 to 2000 during the internet bubble. And if you'll remember back to that, you had the internet stocks, which are akin to the momentum and growth stocks now. They were way up in the stratosphere. Nobody owned value. And then in 2000, when that bubble popped, the NASDAQ lost 70%, but value investors actually made 20% that year and roughly 20 the next year until the recession hit, right? It's kind of set up the exact same way now, where value, even though it had a really good 8-month run, it is still the cheapest it's been in a long, long time, especially relative to the rest of the market. So we think the market is set up for a period of time where value can really outperform. If you're investing along fundamentals, you're finally going to get rewarded. And it may not mean that everything's going to be so rosy for some of those stocks that have now bloated to take up so much of the market that Brian mentioned. So we think we've got a good market. We've got reasons to be optimistic. But again, like when we're talking about inflation, it means we've got to rethink things and not expect everything to work the exact same in the next 3 years as it has the prior 3. And I think that's what we've done as an investment committee and what we've done in our portfolios.
Well, thank you, gentlemen, for the answers to the questions. And obviously, we will be back in front of you, viewers, at the end of September. May start to see some stuff coming out on potential legislative changes on the tax side of things. So we'll make sure to comment on those things and the potential impact on the markets. So thank you so much and have a wonderful September.